Hi everyone, Ramiz Gabriel from IG Wealth Management here. Today I wanted to chat about investment philosophy when it comes to market performance. 2022 was a rough year with off the charts inflation, rising interest rates, and poor market performance. And there are mixed reviews on what 2023 and 2024 will be like. It's times like these that understanding investment philosophy is crucial. Take a look at this chart from Investments Illustrated. This chart shows how investments performed since 1935. You will immediately notice that the overall trajectory is up. US stocks are typically the most aggressive. They carry the highest risk and highest returns, followed by Canadian stocks and so on. Since 1935, an investment of $1,000 in US stocks grew to $12 million. This is due to the concept of compounding interest. Of course, inflation has steadily gone up as well. Inflation represents purchasing power. It is the concept of time value of money. So in this example, whatever used to cost $1,000 in 1935 costs $21,000 in 2022. So to get an accurate picture of investment returns, it is helpful to compare returns to inflation. I've created this spreadsheet here to compare to what we've just seen. Here are the interest rates to get the initial investment of $1,000 to the amounts they would be in 2022. Now let's compare different portfolios to these indices. Of course, in your lifetime, it's very unlikely that you'll be invested for 87 years. So let's think of a realistic time period. Let's say a 30-year-old plans to retire at age 60. So let's look at these portfolio performances over a period of 30 years. We'll start with the conservative portfolio and look at 1992 to 2022. Now you can see that an initial investment of $1,000 in a conservative portfolio has grown to $6,000 in 2022. This indicates an interest rate of 6.18% over that time period. Inflation over that same time period has been 2.06%, which means that the purchasing power of $1,000 is now $1,843. The incremental growth is $4,204, and the inflation is demonstrated here. Now let's look at an aggressive portfolio. Over the same time period, an initial investment of $1,000 has grown to $11,347. This indicates an interest rate of 8.43%. The incremental growth after we factor in inflation is $9,504. Now all these scenarios assume that there was one investment of $1,000 30 years ago and nothing else. Now I want to release this assumption and assume that we're investing $1,000 a month until retirement. Now over that same time period, we've got an initial investment of $1,000, payments of $12,000 a year, and the same inflation rate, 2.06%. Now this means that under inflation, this would grow to $493,000. Compare the exact same to the conservative portfolio. The interest rates remain the same under the same time period, and you see that the conservative portfolio yields $985,000. The incremental amount after inflation is taken into consideration is $492,000. The moderate portfolio incremental amount grows to $740,000, and the aggressive incremental amount grows to $990,000. And this type of investment is what you would see in a realistic retirement plan. Now let's consider what these numbers would look like if we increase the monthly contributions to $2,000. Now the annual contributions are $24,000. Inflation is $984,000, and these are the yields of our portfolios. Close to $2 million in the conservative portfolio, $2.5 in the moderate portfolio, and close to $3 million in the aggressive. And these are the incremental amounts over inflation. $980,000, $1.5 million, and almost $2 million. So of course this is substantially higher than the previous example. Now I want to demonstrate the impact that starting to invest earlier has on your asset growth. Consider what would happen if we change one variable in this scenario while holding all other variables constant. That one variable that we will adjust is time period. If the investment period grows from 30 to 40 years, here is the impact. Of course inflation increases substantially, from $984,000 to $1.5 million. But look at the incremental increases. Under the conservative portfolio, the incremental increase has gone from $980,000 to $2.5 million. Under the moderate portfolio, it has gone from $1.5 million to almost $4 million. And under the aggressive, from $2 million to $5.5 million. So as you can see, the earlier we start and the longer we're invested, the better. And here's a summary for the sake of comparison side by side. The variables are listed here: 30 years, initial investment $1,000, monthly investment $1,000, here's 30 years, $1,000, $2,000, 40 years, $1,000, $2,000. And you can see the incremental growth over inflation. Between these two scenarios, they only changed the monthly investments from 1,000 to 2,000, and you can see the substantial incremental growth from this scenario to this scenario over each of the portfolios. The only change from this scenario to this is the number of years, or the time period. And again, you can see the substantial increase in the incremental growth over inflation from this scenario to this. Lastly, I want to point out a couple of things with regards to the markets. For example, everyone recalls the financial crisis in 2008. You can see the major market dips, and that's why the philosophy is long-term investments. For example, someone who invested here in the early 2000s was still in a net gain position in 2008, whereas someone who invested here lost a lot in 2008. However, still compare here to here. The market always bounced back, and therefore long-term investments always result in a gain. Losses in the long-term horizon will always be regained. Whereas whoever pulls out of the market during a downturn locks in their losses and does not benefit from this regain. In fact, in 2009, many news articles said that capitalism has failed. However, the market performed very strongly over the next 11 years. The same occurred during the downturn that occurred in 2020 that was short-lived, when emotional investors pulled out. You can see that despite the poor performance in 2022, whoever invested here and went through the downturn is still in a net gain position. In fact, the investors that benefited the most were the ones who invested when the market was at its lowest, and they've seen huge gains. That's why I always say that the best time to invest is when the market is low, because everything is on discount, and when the market recovers, you'll ride that wave up. I would never advise a client to do something I'm not doing myself, which is why I'm investing as heavily as I can right now. So as I said back in March 2020, the time to invest is now. The best time to invest is now. That's it for me. Thanks for watching, and feel free to check out my other videos. See you in the next video.